Welcome back to the Accounting Desk, your trusted space for understanding public sector accounting standards. In this video, we'll cover Ipsas 2 cash flow statements, which explains how public entities report their cash inflows and outflows. Stay with us as we break it down with simple examples and insights. Ipsas 2 is issued by the International Public Sector Accounting Standards Board, Ipsas B, and deals with the presentation of cash flow statements. Its main objective is to provide information about an entity's cash receipts and payments during the reporting period. This helps users understand how the entity generates and uses cash and cash equivalents. A cash flow statement under Ipsas 2 is divided into three main categories: operating activities, day-to-day transactions related to service delivery, e.g. salaries, grants, tax receipts; investing activities, acquisition or disposal of long-term assets, e.g. buildings, infrastructure; financing activities, changes in borrowings and equity, e.g. loans received or repaid. Each activity gives insight into how the organization is managing its resources. Ipsas 2 distinguishes between cash and cash equivalents. Cash includes cash on hand and demand deposits. Cash equivalents are short-term, highly liquid investments that are readily convertible to known amounts of cash and subject to insignificant risk of changes in value, such as treasury bills with less than 3 months maturity. These must be clearly defined in the financial statements. There are two methods for reporting cash flows from operating activities. Direct method shows actual cash receipts and payments, preferred under Ipsas 2. Indirect method starts with surplus or deficit and adjusts for non-cash transactions. Ipsas 2 encourages the direct method as it provides more transparent information, but the indirect method is still allowed. Example illustration: show a simple cash flow from operations using both methods. Some investing and financing activities do not involve cash, such as acquiring an asset by assuming a liability, exchanging assets. Ipsas 2 requires these non-cash transactions to be disclosed separately, typically in the notes to the financial statements. Ipsas 2 also outlines key disclosures that must accompany the cash flow statement, such as breakdown of cash and cash equivalents, policy used in determining components of cash and equivalents, reconciliation of amounts in the statement to equivalents in the financial position, restrictions on cash usage if any. Why does this matter? Enhances transparency in public resource management, supports decision-making for budgeting and financial planning, helps in assessing the entity's ability to generate cash and meet obligations, useful in comparing performance across public entities. Ipsas 2 is based on IAS 7, but with some adaptations for the public sector. Emphasis on service delivery rather than profit. Budget comparison is often included in broader reporting, public sector examples and guidance. In summary, Ipsas 2 plays a key role in enhancing accountability in public finance. By presenting cash flows clearly, it helps stakeholders see how funds are sourced and spent. If you found this breakdown helpful, make sure to like, share, and subscribe to the Accounting Desk for more insightful videos. Leave a comment below if you have any questions or if you'd like us to cover another Ipsas.